Okay, thank you very much for joining us on this panel. Super honor to be here. So stablecoins have grown incredibly in the past few years. The transaction volume is almost twice as the transaction volume processed by Visa. So a couple of questions for you is, what's the status of adoption by institutions right now of stablecoins?
I'll do this one. We'll go back and forth a few times.
Rapid fire.
Now, there's a really interesting question. Todo mundo me escucha, ¿verdad? Boom, boom, boom. Okay. It's funny. I hear this Visa stat a lot. And I love Visa. I love MasterCard. But I think it's a very interesting look into how much we actually understand payments and institutional adoption, because in reality, the volume on Visa or the volume of these stablecoins is higher than Visa, but it's not an appropriate metaphor always, right? Because most there are stablecoins being used in payments. Most are being used more for like a speculation. I don't say that in a negative sense, right? But it's usually like a DVP of I'm trading USDC for ETH or for WBTC. And really, it's still being dwarfed because in the actual world of security, settlement, and reconciliation, the volume is something a little bit more like 1.5 trillion a day, right? And it gets us to the point where I'll probably repeat this a lot. I think one of our big challenges is that like no one in crypto knows anything about banking, and no one in banking knows anything about crypto, and we're two like very arrogant groups who will never learn about the other one. So I think a better way to analyze a little bit, there's no one thing called a payment. There's actually like 5 kinds of payments, right? So yes, I think in the kind of stuff Visa does, which is card and largely like payouts, disbursements, the kind of things you see in like a Airbnb host getting paid. But to step back for a moment, at the top of the thing, there is like real wholesale payments. And these are not like, usually like the payments that go over Swift. And everyone in crypto lies. They're like, oh, I sent a wire and it got lost the other day and it took forever. No, you didn't. First of all, I've worked in wires a long time. I've sent like one wire my entire life. And 90% of wholesale wires get credited within 10 minutes. And they're actually end-to-end trackable since like 2017. But at Consensys, MetaMask, is one of our products. But we also work with Enterprise a bit. We're working with Swift right now on those. And these are the type of payments for financing like $1 trillion like oil rig or like a large scale like solar installation or settling like $1 trillion worth of securities at a custodian. Those payments work well. The headache for the banks is actually that the liquidity management. The payments process is fine, but in order to effectuate those payments, they have to have like 10 to 50 trillion in pre-funded accounts around the world that they could be like, using for corporate financing or mortgages or something better than just money sitting dead in a bank somewhere. So like that's one place where I think you're seeing a lot of innovation. We have this new Swift chain. We can talk maybe a little bit later about how they'll actually capitalize the assets there. Then there's cards. Cards are super fun. We love cards. Jamal loves cards. Check out the MetaMask card, by the way, card.metamask.io. We built a lot of infra for that where we don't just allow stablecoin spend. We allow like DeFi deposits, like your Aave deposits, so you can earn interest until the precise moment of purchase, spend cryptos. We build that infrastructure ourselves, but one thing that makes us really happy is MasterCard and Visa are introducing some native settlement on their networks, USDC, URC, and that makes our lives easier and it helps other people launch. Then you get to this like payouts, like the type that Visa's doing, and MasterCard Send. This is not the cards. This is like what powers behind Uber or Airbnb. I think there's a lot of work to do in terms of making sure that folks can be like credited to those different accounts. So it's more around like figuring out the travel role and such. And then of course there's new payments that we don't even consider yet, like micropayments. It's not really that fun to pay someone a penny, but in real life usually. But like I would like replace likes for a penny, on a social media platform. I think it'd be more equitable. And it really hasn't been possible for the stablecoin. So there is a lot of great stuff happening, but it's really important to understand that like it's in very particular flavors in these institutions, and even in these institutions, people don't know each other, right? Like if you talk wholesale payments with like JP Morgan, you're on like 47th Street and Madison Avenue in New York. When you get into like retail remittances with them, they're like, oh, that guy's in Tampa. Like I don't even know him, right? So it's good that there's institution, but there's not one lane of like stablecoin payments institutional adoption.
I guess we should all just like add some points to it, but unless you guys want to keep it by question, but When I think institutional, obviously like the banks are a big part of it, but I consider some of like the PSPs and other payment companies getting into the space also kind of an institutional adoption. I think the most important thing is that you're seeing regulated service providers who have done this type of work before slowly start to understand what blockchain rails can do. And I think it's important that we reinforce that we're not trying to replace existing systems. Like Daniel said, like this, existing systems have worked for a good amount of time. They just need to be upgraded with additional features and services that allow for seamless transfers, better experiences, more cost effectiveness, whatever that reason is. So I think it's important that these like key distribution points start to take advantage of some of these new solutions. Like, you know, companies like Stripe getting closer into the space by adopting deeper blockchain rails and then delivering that downstream to merchants who don't need to know that blockchain is under the hood. They just want cheaper, faster, more efficient payments. So I think that's starting to happen now. I think you needed to see some like regulatory stuff happen before that started to happen, which is like got people a lot more comfortable. But yeah, I think that's like the key point is that like getting to a distribution point and then using that to reach all the merchants in a way that they're comfortable with.
Yeah, I mean, I think the super key thing you said, which is that, you know, these figures, twice Visa, twice MasterCard, whatever, often misleading. There is like an incredible amount of growth, but there's a dearth of information when it comes to, hey, what is actually going on? Is this a payment, or is this, you know, the same, you know, 7 wallets recycling the stables back to, you know, pump up to whatever number the VC needs to hear for the next round? Yeah, absolutely. And I mean, I think there's very real adoption of stablecoins, but it feels more and more like there's a divergence. You know, there's the more casinos, maybe a strong word, but, you know, the more speculative side of crypto. And then there's more emerging markets, which is very, very different. We have people that bank. You know, I bank through a lot of stablecoin neobanks. I've gotten paid in stables for 5 years. And so I think those two worlds are very different. I think that's where the institutions that come in, it's going to be boring. It's not going to be flashy a lot of times. And they'll come in doing this stuff, which is just upgrading. It's going to be under the hood. Maybe they won't even tell you, you know, it'll just say digital dollars. You won't know it's stablecoins under the hood, but it'll be stablecoins. And what really matters is giving the consumers a better experience.
Great. You mentioned regulations. We have seen a lot of movement in that sense with MiCA in Europe, the Genius Act. Brazil has enacted its regulations 2 weeks ago, last week. And many of these regulations kind of mirror the requirements of banks. What's your view on that? How do these regulations impact on the innovation and adoption of stablecoins?
Yeah, I can start here. So I think there's a lot of nuance here, and a lot of these central bankers, particularly in Latin America or emerging markets, you know, they have a willingness to learn. They have a desire to understand, hey, why are people using this so much? What's so great about it? And that's great. You know, the generic, there's more work to do, which is very true. There's a superficial level understanding a lot of times. They're understanding the capabilities and not what's going under the hood, which maybe an end consumer doesn't need to know as long as they're safe. But the regulator does need to know because they need to decide what is safe. I think then what we've seen is there's a lot of stratification within how comfortable central banks are, or how they understand it, whether they want to incentivize local stables or disincentivize local stables. I think what's great there is clarity and coming forward to the market. I think the regulators that are going to see, hey, you know, the market or the companies that are both national and international that are coming to work with them are going to be very happy, is when they say, hey, we'll have a conversation. We'll have a working group. We'll sit down with these companies and really understand, hey, what do you want to do? I think there are parts of the traditional system that are broken or, you know, slow or not great for consumers or don't give optionality. And there's a lot of power that you can give, you know, whether it's B2C or B2C side.
I mean, I think that regulation is very important. I think it creates safe and sound transactions. That's obviously a critical driver of a lot of the success. If anyone thinks that regulation hasn't helped this like current stablecoin boom with like Genius and MiCA coming out, then I'd like to meet you there and talk about it and argue against you. But ultimately, I think that we need to have some of these regulatory concepts in place in order to make sure that transactions and just any sort of building is done in a safe and sound manner. I think that involves working with a lot of like big regulated players as well as regulators themselves in order to define what does the future of this technology look like and how are we building and what are we trying to do. I think that's like starting to happen slowly now. You're seeing like quite a bit of like traditional bank, traditional fintech interest in the space, and they're kind of coming in and saying, As Daniel mentioned, like a lot of the two worlds don't mix. So like now that the two worlds are converging a little bit, you're starting to see a sharing of ideas, and that sharing of ideas is actually getting to a really good balance of how do you do regulatory clarity, how do you give like safety and soundness to the users while still allowing the technology to be fully unleashed and fully functional. I think, yes, it does stifle the innovation a little bit, but ultimately, at the end of the day, the customer experience will benefit long-term from having regulatory concepts that keep them safe and sound, that make sure that they're protected, that make sure that they don't have bad experiences, because those types of things get people to shy away from the technology without ever coming back. So I do think that, yes, we could be growing faster. Yes, we could be moving faster. Crypto moves at the speed of light. And regulation is a little bit slower, of course. But ultimately, I think it's creating the right framework for us to build methodical things that are going to be really powerful and really go to scale and actually change the existing financial system.
Yeah, so first, like a caveat, I work in product and strategy, so don't listen to anything I say about regulation. We have a very good head of global policy named Bill Hughes. He worked at like the White House and Congress. Follow him on Twitter. He's got a lot of good commentary. Okay, all that being said, I got a hot take. You may have never heard this one. I like it when regulation's good, and I don't like it when it's bad. And some of it's mid. It's kind of a little bit of both, right? But ultimately, am very heartened by a lot of things you see around like Mika and the Stable Genius law for two reasons, as Jamal notes. Well, I like that it lets us have clarity on what we can build, but it also protects the consumers. Like part of Stable Genius, that like in being a stablecoin holder, I know that I will be made whole in the event of an issue, much in the way that if I had like funds custodied at Bank of New York. That's how custody law works in the U.S., right? And I think in most countries, right? All that said, though, I got to say, like, I get a little bit like bored sometimes when people talk about regulation too much. Both bankers and crypto people, because I think it's kind of an excuse for not building stuff. And just like some examples is like on the crypto side, Agora, Polygon doing very interesting stuff for years. We've been doing it, Circle, before the Stable Genius law, right? Before Mika. Your job as a technologist is to look at what you can do, look at the laws, and then figure out something you can build, right? And just deal with it. So like the MetaMask card, again, la tarjeta MetaMask card.metamask.io. Disponible in Argentina. No, but we're like trying to launch in the U.S. and like, you know, in the New York, they have the BIT license. So we have to figure out how to like comply with the BIT license. In Texas, they wrote like an anti-CBDC law, but I don't think they wrote it like correctly. So really the way it works is, I'm not judging them. Maybe they did mean this, but you actually have to swap everything to DAI before you spend it. You can't even use essentially, like if my users want to spend USDC or MUSD or some of Agora's wonderful tokens or USDY or whatever, I actually have to have an intermediary flow where it switches to DAI before I go back to dollar because the payment instrument has to be a sufficiently decentralized one, right? And I could say that's a bad regulation or a good one, but it's just something I have to deal with, right? And I think a lot of crypto people kind of, you know, make these excuses not to build stuff. Now, to criticize the banks, same thing, right? There wasn't regulatory clarity for a bank to offer like ETH or Bitcoin to its end customers, and I'm glad that's getting resolved. But like banks are allowed to like trade currencies, and if it's tokenized, that's just something you have to build. So actually, before all this, December 2022, our good friends from Polygon, Consensys, MetaMask, and as well, I think Aave was involved with JP Morgan launched a Japanese yen, Singapore dollar swap market, not test, live, real in Singapore, where you could swap on like a institutional DEX. This is in, I think, November 2022, right? And these are live, non-test transactions. And then for tests, they also did like this little Aave pool where you could drop like a 10-year Singapore bond and pull out Japanese yen. And I'd be meeting all these banks all the time, and they're like, oh, we're waiting for regulatory clarity. I'm like, dude, just copy and paste what JP Morgan did. It's a cool project. Do it. Instead of 10-year bond that I loan for Japanese yen, you could do, I don't know, whatever, auto loans for ice. And I would talk to these banks, and they're like, oh, I don't get it. It's because they haven't read enough about crypto, or they haven't done the product work or the strategy work to do something that they were totally allowed to do. A bank is allowed to trade Japanese yen for Singapore dollars. That's clear. They just weren't taking the next step of the tokenization. So again, I'm super happy when like good regulatory developments happen, and I praise all of the legislators, regulators that are doing it. But it ultimately, I think we all are probably in agreement, like it's your job to like just sit down and read the laws of every country and figure out what you can and can't do. And when you understand what you can do, go do it. Because I think when some of these regulations get passed, it's like the ocean goes down y enteramos quién está sin traje de baño, ¿me entiendes? Que está desnudo ahí en el mar, because they haven't done the investigation, the research, or any of the work backing what they could launch, you know? So good and bad. Good regulatory movements, but like good or bad, a challenge to all of us to not use it as an excuse not to build things.
Yeah, I mean, I think where they're good is that they'll level out the playing field, right? So kind of the conversation of the past bit, especially after the flash crashes, the other weeks, is what is a stable coin? What is a yield coin? What is a tokenized hedge fund? And so I think that's good where a regulator can come in and say, hey, if you want to call yourself a US dollar payment stable coin, these are, this is the backing you can do, this is what you have to do on the marketing side, et cetera. And I think that stuff's great because most consumers, in crypto, we have a lot of education, and so that's great. But the reality is most consumers, and if you want to go mass market, most consumers don't have the time, they don't have the expertise, they don't have the desire to learn deeply about these things. And so I think that's where regulation can shine. And so as far as saying, okay, this is what you're allowed to hold for a payment stablecoin, and making that very clear. And then if you want to be outside of that, that's fine, but then you're a tokenized hedge fund or your yield coin or whatever it may be.
Great. We were also discussing before this panel CBDCs and tokenized bank deposits as potential competitors to stablecoins. What's your take on that?
Oh yeah,
Let's be democratic. We're all going to start first.
I love this one.
We're all going to speak, so you may as well hear us in different orders.
Yeah. I don't think the two are competitive. I think that the two will exist peacefully. I have a very specific thesis on like what I think is going to happen. I'll like share that. I think it's pretty interesting. Both are interoperable. Like both will work and function in the same way. Both will work with exchanges. Both will work with any sort of PSPs. Both will work with the MetaMask card, card.metamask.io. Check it out. But all of them will be interoperable, but both of them will have very specific functions, right? So what we think tokenized deposits will do that makes us actually really, really bullish on them is that they come with depository protection. And I think that that's great for people who are looking to do treasury management, who are looking to on-ramp into the chain space. However, people like JP Morgan, who we love because they built their tokenized deposit program on Polygon, or people like HSBC, who we love because they also did the same thing, we think that those people are not interested in going out and being liquid, or going out and doing all the right integrations, or going out and being traded at all the exchanges, or being available as collateral in very, very liquid markets. So what we think is going to happen is there will be tokenized deposits. It'll be the future of on-ramping. It'll be the best way to on-ramp. It'll have depository protections that come along with it, which will make customers really safe and happy. And that will expand JP Morgan or whoever's network a little bit. It'll make their network a little bit more, seamless, a little bit whatever. But it's not going to take over the world. It's not going to replace AUSD or MUSD or USDC or anything like that, because they're not going to go out and do that legwork. What there will be is, in my opinion, there will be a clearing function that will take JPMD or whatever tokenized deposit and have a one-to-one swap directly into liquid stablecoins like Agora that then will go out and do all the liquid work to be useful, right? And I think useful is a better word than liquid there. But useful means I can take it and spend it. I can take it and trade it. I can take it and buy something.
You can go get pesos cash here.
Yeah, absolutely. You can load it on your MetaMask card, card.metamask.io.
Or the Cueva, if they'll take your tokenized deposit on the Cueva.
Pesos cash.
I went to my first Cueva this week. What an experience. Very, very interesting. I also feel like a millionaire when I take out like $500 in USD, and I'm like, I have a stack of cash this big, so I'm going to come here more often and maybe film a music video. But ultimately, I think that like both of them have very, very strong footholds in the space. Again, there will be a clearing function of someone be able to take that tokenized deposit and provide one AUSD for it, and then AUSD will be liquid. You'll go trade that in the markets and do all this stuff with it. And then when you want to go back home, you swap back one-to-one back into JPMD. Or let's say you want to do a cross-border payment in Singapore dollars or whatever. You take a JPMD deposit token. It goes one-to-one into AUSD. AUSD is liquid against XSGD, which is another stablecoin that we see from StraightSex on the Singapore side. And then there's a very liquid market for that. So maybe you're beating the mid-market rate, or you're beating some sort of like cross-border transfer method. And then you go do the same exact function on the other side. You take your XSGD and you swap it for a DBS Singapore dollar or whatever. And then you redeem that. And I think that's how the future of cross-border payments will work.
Yeah, I think I agree with parts of it. So I think there's great things about tokenized deposits, et cetera. I think one of the things and I speak about this with regulators sometimes. One of the other things is that if you're a bank, you already have a very solid business model, and so you don't have so much need. And you know, they'll go back and forth on this. I don't know how many of them will admit it, but I think a lot of executives at bank view themselves more as an asset manager. You know, I take in debt at zero because I don't really pay my consumers very much, and then I emit into the market into a portfolio of mortgages or whatever it is, and I make the spread on that. And so they don't really view themselves as a suite of financial products, but really kind of the revealed preference is they look more like an asset manager, basically, where, you know, they have this huge portfolio and they get to eat a couple bips off that or however much it may be. So I'm very skeptical that there is going to be this innovate. I hope, you know, hopefully there is. We're always happy to see more innovation, but I'm skeptical also just because of the way the equity structure works, right? You know, if you're at Polygon and you guys don't innovate on the infrastructure level, you guys are default dead. If we're at Agora and we don't innovate in stablecoins, we're default dead. If you guys are at MetaMask and you don't innovate, you're default dead. And so that's where there really is, you know, a fire under your butt to say, hey, you have to change this. You have to create a better option for consumers, or your company doesn't exist. Whereas if you're at, you know, JP Morgan, whatever, you know, many of these banks that are great, but they don't have this intrinsic need to really deeply. So I think they'll do it. I think they'll do it half-heartedly. I think the UX won't be great. I think there won't be all these integrations, same way you're saying. And I do agree that hopefully we land in this nice place where at least they're like a great way to on-ramp and off-ramp more seamlessly, for sure.
Yeah, I think this gets back to the first thing I was saying around, like, there's just different types of banking that may as well be different disciplines, right? So, like, I work on MetaMask. I work on the MetaMask card. I won't pitch it again. But separately, we're also helping Swift build their blockchain, right? Swift is working with Consensys to build an L2, not an L1. Shout out Swift for being Ethereum aligned, a real L2. And when you think about those type of payments, like, okay, there's a card payment. Maybe there's a remittance that a mother in Jackson Heights sends to her cousin in Colombia, right? Or Medellin or something like that. Jackson Heights is a neighborhood in Queens, New York. That's very Colombian. Sorry, I should explain that. But you got these remittances. You got these disbursements where, like, an Airbnb host or an Uber driver in Mendoza wants to receive, like, Agora coins directly to his EOA instead of, like, a peso to his bank account. And I think there's going to be a lot of innovation there. If you want to work in that kind of space, if you want to build some type of neobank, talk to these two guys. They're really great. I really highly recommend them. But on the banking side, like, the equivalent of the world GDP gets instructed over Swift every 3 days. There was a single day this year that JP Morgan did $15 trillion in payments. No offense to any individual stablecoin company. You put them all together, count to three. 1, 2, 3. All right, boom. In the 3 seconds just then, 2 banks alone on Swift probably sent more value, even like on a Saturday, than the entire market cap of all the stablecoins. So in order to support that volume, which is not, again, for us. It's not for, you know, remittances. It's not when you send money to your aunt. It's not when you pay for a pack of gum or a beer. But for these large wholesale payments, security settlement, financing of very big projects, trade finance, when this happens over the banks, they will have to arrive at a way where they have some type of either tokenized deposits, where there's some type of insurance and they can trust each other, at least maybe some counterparty risk, or like mutually created, like pals of money. So as I mentioned before, the banks have 10 to 50 trillion sitting at other banks just to send payments, and they don't want to do that anymore. They don't want to hold it. If I'm the bank that the account's sitting with, that's called a Vostro. It's Nostro Vostro. It's the same account. But like when it's my account and yours is the Nostro, when yours and mine's the Vostro. The Vostros at my account suck because I don't get to make money off of them. They're not part of like my financial reporting. And the Nostros I hold elsewhere is just lost money, right? And in order to reach the volume of those real wholesale payments that they want to enable with these, they're probably going to, there's been an announcement probably for the Swift thing, for other reasons. Like I think 20 European banks are going to get together and do like a good like 750 billion worth of Euro coin, right? That'll be mutually exchangeable between them. There's Santander, I know Citi joined, I think ING. So really it's ultimately a question of stepping back and saying like, am I building a neo-banking thing? Am I optimizing for lending and payments for SMEs? SMEs, great. Bitso, I like these guys. The Mexican exchange. They have this thing where they leverage the fact that they're exchange in Mexico and in the U.S. where they have banking relationships, and they're quietly capturing a lot of the SME volume. You know, you're like a auto parts manufacturer with like 25 employees. By leveraging their stablecoin capabilities, they're capturing a lot of the U.S.-Mexico corridor. They're probably not going to capture, though, that, you know, $150 billion mezzanine financing thing on the new Torre de Angel or whatever that city is paying Banamex to pay Banorte or whatever, right? So it gets back to the specific use case of the money. And there, I think on that wholesale side, tokenized deposits are not just like interesting, they'll probably be necessary. Whereas I have to agree a little bit here. I'm not sure they're going to be retailized that well unless there's a bridge. So I agree with both these fellows.
Great. The main stablecoins going around are USD-denominated stablecoins. In the last couple of days, many local currency-denominated stablecoins have been announced. What's the utility for users and institutions of this type of stablecoins?
I think the local stable business is tough. You need two things. You need both of them. You need a friendly regulator that will make clear laws, but allow you, the risk-free rate in Argentina isn't risk-free, right? As many a fund has known. And I've met many people, this week that have done great on Argentine bonds over the past couple years, maybe not so much over the past couple decades. And so that's one thing, having the clarity, but hey, is there going to be a profit incentive? What yield can you do? What, underlying can you have under that, for example, for an Argentine peso? Number one. And then number two, you need probably an anchor company that is rather large or a specific sector that you're going after. Because in the short term, until you build up this liquidity flywheel, until you build up interoperability on DeFi, et cetera, you don't have this great service, right? Stablecoins, I think the stablecoin sandwich is not super interesting. I think it's interesting when you're staying in stables on one side or you're coming in from stables on the other. And if you're just swapping through, then it's not interesting. I do think what these local stables will also allow is, which will be great for consumers, is right now you have a sandwiching of the on-ramping with the FX. So the same company that's on-ramping you is also giving you FX, and so you have both of these things together. And so I think being able to disambiguate, having two different layers here should probably lead to more competitive pricing. Because a lot of these, banks or whatever it is will offer nowadays, we do feeless swaps for FX, and it's like, great, but your book looks like Moses parting the Red Sea. I got to hop over, and it's like quite brutal and painful. And so I think disintermediating where you'll do these things separately or you have the option to do them separately will force these people to be more competitive.
Yeah, so totally agree that like the dollar right now is pretty dominant and probably will be, and there will have to be like the correct regulatory frameworks and the right actors. But I do think a lot of them will pop up to please people, but also to make money. I mean, it's both ways, right? Like there's an opportunity. People pay in the real world in Swiss francs, euros. They do it in RMBs. They do it in yen. In fact, the IMF, when they make loans, Argentines know a bit about this, they don't loan you in dollars. They loan a synthetic basket called the special drawing rights, which is a combination of like RMB, yen, Swiss franc, euro, dollar, which is recognition that the dollar, although it's big, it's not everything, right? And I think you really have to serve these people. So like in the card business, I hear like people are like, oh, I like your MetaMask card. You have a better FX than the others, but I still hate like people complain to me like, why are you charging me FX for spending USDC in Argentina? Our card is the lowest FX allowed under MasterCard's rules. Other people like fleece you a little bit, but you're still going to get hit because I can't solve the problem that you want to pay a merchant who needs to receive pesos. That's an intractable problem. I can't let you spend dollars at a place that wants to receive pesos without any FX. That's not viable, right? So I think there are cases where maybe we could develop better products. Like some people just like their local currencies, I mean, they're not really that bad. Like Brazil has inflation, it's like 7% or whatever, right? 8%, but their federal funds rate's like 13. Technically, if the real outperforms the dollar for the next 2 years, I'm better off owning a tokenized Brazilian real than a dollar, right? Euro, for example, has been outperforming the dollar this year because of the magic of the blockchain. I'm walking around New York spending euros with my MetaMask card, and other cards allow you to spend Eurosea from Circle, so that's great. So like there is a demand. The question is though also like how to serve people. So like these Argentines that complain that they want to spend USDC, but they're sick of getting hit on FX every time that they make a purchase. I could imagine a world where they take a stable, maybe a yield-bearing stable, or one that's not, and loan it into something like Aave. They're making the yield. But I was out with two bankers from a bank that won't be named the other day, and they were like, hey, tell me more about this DeFi. And they didn't know much about it. I just took out a $200 Aave loan on the spot to buy lunch for them. Like, oh, it's that easy. Wow, okay. So I could see a world where some of these Argentines are saving in dollars in DeFi and then just taking out little peso loans every now and then to settle that. And I think that would be a really great way for them to diversify their savings, get yield, lower that currency risk, but then diminish that FX thing that they're getting hit with, because ultimately the on and off ramp is pretty difficult for folks. And then whether the user wants it or not, people are going to be incentivized to do it, right? Like maybe you have like counterparty risk or whatever with like maybe the Argentine or the Turkish government, where they're going to default on the bonds or not. But if you don't have that worry, even if the money's going down or whatever, like I could issue I'm not saying I will, but even if it is, a currency that's performing badly against the dollar, if I'm backing it with that currency, the user's already, it's a 1-to-1, and I'm just buying a bond. If I'm making like 14% on the bond, as I think that's the average federal funds rate for Brazil, why wouldn't someone make a Brazilian real, stable coin, right? So I think the combination of people need it, people want it, they want the convenience, and someone's going to step in. I mean, there's enough bankers and crypto people in the world. I don't know. There's a lot of currencies. I don't know when the Botswana Pula, that's a currency, is going to get tokenized, but I can guarantee you like the top 100, we're probably going to see some interesting stuff.
I think the last thing, which is something that consumers might not have visibility to, is you also have the synthetic ones. So you've probably heard about these a lot, and you guys up here on the panel. But so these are actually backed by dollars that are then hedged against FX and fiat markets. That way it's a little easier around until the regulation caps up, or until it's clear, hey, how much profit are you allowed to seek on these, or how crazy of an instrument am I allowed to sit in, whether it's an Argentine peso or Botswanan currency or whatever it is. And so there's also the synthetics that I think are more practical in the short term. Hopefully, as the regulation comes in, it'll be more clear. Was just catching up with the guys from Mento who are here, and they do it synthetically, for example.
Yeah, I mean, I agree with what both of them said. I think the regulatory climate, how the local regulation plays out, how the local players play out, how the banking system, because obviously every fiat-backed stablecoin is going to have a banking partner locally. I think all of that is critical infrastructure, but overall I am very bullish on the ability to get more demand for non-USD stablecoins. Of course, the USD stablecoin is always going to be the most dominant. It's still the reserve currency for like a lot of the world.
While the dollar is the most dominant.
Huh?
I don't want to get too controversial. In a dollar, maybe it will be. I'm not saying it won't be. But in a world where many currencies are tokenized, whatever the strongest one will be the best, right? Yeah.
Bitcoin maybe.
Because they'll just swap it, yeah?
Yeah, we'll see. No, I agree with you. 100%. But like until that happens, which is like a healthy, very, very good paradigm shift, until that happens, I think you're going to continue to see the same kind of world order that's happened, which is USD dominance. But I think locally people want local currency. Like they want commerce in local currency. They maybe want to save in dollars. They may want long-term instruments in dollars, but they want to transact and interact with their friends and whatever in local currency. And like that's very prevalent here, right? Like a lot of people save and hold long-term assets in USDT, but they still prefer, or they still shop and they still do whatever they need to do in local Argentinian pesos. I think that there's just not enough tokenization demand for that. I think that's going to slowly happen over time. I think there'll be more infrastructure, and I actually think that I'm very bullish on the ability to, with enough liquidity and with enough depth, be able to do a lot of this swapping on chain. I think an automated market maker is going to be a better mechanism for swapping than building with people and salaries and benefits and whatever. So naturally, that has to be more cost effective. But I think, I think that like you need to have a lot of stuff in place first. I think that's like slowly happening. The regulators, the central bankers, and a lot of these different countries are starting to see that they are eating away at their own local deposits with USDC, USDT coming in, and that money sits overseas. That money sits outside of the economic system. And they recognize that if they don't come up with something soon, that they're going to see a lot of lost market share to a lot of these external stablecoins. Like USDT sits in, not in the US, but like close enough to the US, but not here in Argentina. But how much money is being held in Argentina specifically in USDT? So I think that is starting to motivate people. They're starting to see that has exploded on the other side of the shore and that they need to kind of respond with something. So I think that will start to give a little bit more like regulatory clarity. And once that's there, and banking clarity, once that's there, you'll start to see a little bit more demand, a little bit more infrastructure being built, builders starting to play with it. And I think that will lead to a little bit more of like this on-chain infrastructure that will make it more retail viable.
Great. The name of the panel is Stablecoins Turning Traditional Finance Upside Down. Are we on track to see that in the next couple of years?
So again, depends, right, on the specific vertical within. I mean, stablecoins. Really, I think there's like three things that people are thinking about primarily. It's maybe four: saving, spending, lending. Saving, spending, lending. Yeah, that's it. Yeah, all right. Saving, spending, lending.
investments?
Credit, the flip side of lending, right? So like, since Mesopotamia, these things exist, right? It's not even like everything associated with capitalism. This stuff exists way before capitalism. People were saving, spending, lending, and feudal, like Middle Ages under mercantilism. They did it under communism. They do it everywhere. The question is at which scale and in which cases. So I think certainly, like in the neo-banking side, has been mentioned a few times here, whether it is explicitly someone who knows it is crypto, right? Say someone with a MetaMask card using MetaMask to access Aave, perhaps on Polygon. They make a loan. They get their 3-4% interest. They're outspending it. Or whether it's in a much more white-labeled way, as we noted with some of these protections, I think people can feel a lot more comfortable that maybe I'm using some type of neo-banking app where it's stables on the back end. I think superior products are just, undeniable that they're going to take up a pretty large proportion of that market. I think about the interest rate that I get on a savings account in the world financial capital of New York. I'm getting 5, 6, 7%, depositing to pretty safe, like Morpho Aave pulse. I'm outspending with the card. Why would I be getting like 65 bips from my bank? And when I want a loan, I just take it out of Aave the same way, and I'm paying like 5.44% instead of 27 as I do with like an unsecured revolving credit line. When we talk about those bigger banks, there will be, the bigger banks are also in retail, but I mean they're big operations, big wholesale settlement, large like tri-party lending, the repo market. That's going to take a little bit of time, mostly not because of the technology, but again, that challenge of how do you bring the value onto the token, right? Like it was easy for us to get retail stood up and back some USDC with some bonds, but suddenly when it's like like $150 billion tri-party repo loan, okay, I can create a smart contract for that, but how do I even get the $150 billion worth of asset on a chain? Yeah.
Yeah, I think on the consumer side in emerging markets, we have seen it get flipped upside down. I always say, I don't want to bore everyone with the same thing, but I've gone on payment stables for 5 years now. So before, people were even talking about, the business model and it looks great. And, the interest rates were lower back then. And, but so I think there it has already turned things upside down quite large. And then I think there's an opening up of opportunities where, hey, the rates for dollars here, most banks won't offer you rates on dollar deposits here. And so you go to Aave, you go through Polygon, you go into Agora Vault using your MetaMask.io card.
Card.metamask.io.
Yeah, hashtag ad. But and so I think there what you'll have this great democratization. And what's great about that is it's a no-brainer, right? I mean, your country either has a higher borrow rate or a lower borrow rate. And so on one side, either on the credit or on the deposit side, global interest rates will be better, right? And there will be less intermediaries, like you were saying, you don't have to pay a bunch of people at a bank subsidiary somewhere near your home. You can log in on your phone. And I think it also harkens back to what I was saying before, which is, you were saying this, like your U.S. bank doesn't pay a lot. And something you also have there is you have price discrimination. Like I'm sure my grandfather gets much, not as great a deal from his bank as I do, just because, he's banked with them for 60 years. He's stuck there. They know he's stuck there. He has his mortgage or whatever. And he's not going to move off of there. Whereas, maybe I'm a little bit more savvy. And so, this neobank or this whatever has a great rate and I can get a great rate there. And so I'll use that instead. And that's kind of the counter side of what I was saying before, which is, hey, the equity structure in these new companies, in these startups or these, more mature tech companies is such that you have to innovate. Whereas, hey, JP Morgan goes and gets my grandfather, he's, banked with them for 60 years. He's kind of stuck there and they kind of know it. And so they don't have to give him a lot to get his business.
Yeah, no, I think when I think of like institutions, I'm admittedly like a payments guy, so like I think about like Visa and MasterCard a little bit more on the banking side. I see like large PSPs getting into the space, payment service providers who like, people like Stripe or Adyen or Checkout.com or whatever. I think that they're starting to realize that, well, number one, I think these blockchains are just new payment rails. I think maybe that's like a oversimplification. I think they're like new financial operating systems, but to these existing players, these are just new payment rails, just like they were adding cards at one point in time, or just like they were adding, Swift at one point in time as well. So I think you're starting to see on the payment side a little bit more like a fear-based approach. Like Visa and MasterCard are a great example. Like there's clearly a use case for stablecoins and blockchains to disintermediate Visa and MasterCard. However, they've done an amazing job injecting cards directly into those flows. Card.metamask.io. It's an incredible product. I have one. I've been using it locally. It is actually genuinely the best FX rate here. And we're not being paid by MetaMask in any way. I'm like a free evangelist for sure. But no, I actually think
I have Agora holdings on and I use Polygon every day as well.
That's the only thing I
cap.
use. Yeah,
It's
yeah.
true. It's true.
So, I mean, jokes aside, we all love each other.
I'll spice it up for you a little bit more. So I'm curious, when do you think we'll see, and we're coming up on time, so I'll do it quick, but I think this will be an interesting one. When do you think we'll see, end-to-end? Because right now it's the card, the way you're saying. So do you think there's a timeline? Do you see the companies, do you see the funding actually coming in for actually the merchant who's selling me the coffee to actually receive stablecoins, be they local or be they US denominated?
So, yeah, absolutely I do. I think number one, like on the a little bit more cannibalistic side, you're seeing that there's like really interesting solutions being put together with like a combination of hardware providers like the POS terminals, the issuers, the acquirers themselves, where you can actually, like you guys have seen like Arculus, like really, really cool tech where you can put the actual private key signing ability on the card itself as an NFC chip. So imagine going up to a like terminal, tapping your card, and it actually checks, does this merchant have a stablecoin wallet? It does. Instead of using the scheme rails, let's just go ahead and settle directly on stablecoins. And that can all happen within the 5-second auth window that a terminal gives you, right? So I think you're starting to see some more cannibalistic stuff on that side. But I actually think that like Visa and MasterCard can live within that as well, because they can give you an authorization data window with having like a direct facilitation. So like Visa and MasterCard don't have to actually do the money movement for them to provide value. They have a strong auth window, they have a strong data protection layer, they have a strong connective tissue, and that can actually be used to facilitate stablecoin settlement, but still have tremendous value to have Visa and MasterCard as the data intermediary in between that. So I think that's going to start happening going forward. Sorry, I'm getting really excited about this. But that's going to start happening going forward. And I think that Visa and MasterCard live within that. They just take less economic slice in that value transfer, but they're still providing a very valuable service.
Thank you very much. Unfortunately, we ran out of time.
We could do this for 3 hours. We're payments nerds up here. We love this. We'll be here all day.
Yeah.
Thank you so much.
Yeah, thank you very much.
Thank you for having us.
Thank you for having us, guys.
And thank you, Crecimiento. Thank you, Aleph Hub. Give it up for the Aleph Hub
it's
Crecimiento
great.
folks.
Teo and the team.